frankly think we're topping right now. And I have been thinking that we're in a topping process for several months now. That doesn't mean it can't go up. I mean, you're up until you're down, right? Joe Granville said that. But we have numbers below the markets, both on the NASDAQ 100, which is our leader index. There's no question it's been the leader. It's outperformed everything. The top 5-6 stocks in the NASDAQ 100 constitute over 50% of its weighting. We all know those symbols: Amazon, Apple, Microsoft, Google, et cetera. They also constitute probably about 25% of the weighting of the S&P 500. So as these indexes have moved up, it's not because of all the symbols within the index. It's primarily because of the leadership has been so strong. And therefore, focus on the NASDAQ 100 because that's where the leadership is really weighted. We see numbers below the S&P and below the NASDAQ 100 that aren't that far down there. In fact, I just throw out some numbers for you. Around 4,400 S&P, you don't want to see it ever again. And these numbers adjust upward each month, by the way. And on the NASDAQ 100, which is 16,000 plus, you don't want to get back much into the high 14,000s ever again. If you do, we're going to trigger some annual momentum structural breakage points, which we measure not on a price chart, but on annual momentum charts. And by that, I mean when we measure those two indices in relation to a 36-month average. That's not where those averages are, but that's where the structure is on the momentum charts. So what we're saying is the market can't afford even a 5% drop and certainly nothing approaching 7, 8, 9%. You're going to start to blow these structures. And when you do, we're going to declare top is in, it's over. Then you get what you get. Now, considering that we've had a dozen-year uptrend, it's scary. And it's scary because if you're a price guy and you're looking at, let's say, a weekly or a monthly price chart of the S&P or the NASDAQ 100, and you look at your screen, try to define where you think it breaks. Try to draw a trend line. It's almost impossible. Whereas you might draw one and then it goes up at a steeper angle. We have to draw it again at a steeper angle. It's like multiple lines. So there's no line that touches 3 points. It's just a curve. The problem for the price chart technician at this point in time is when you turn down, there's no consensus as to where, oops, it broke something. And when you don't have a sense of, where you are on the map, emotions can take over. Mm-hmm. Panic can ensue. So it's going to be an interesting game this year. And I think 2022 is going to basically resolve it all. And there's a lot of stuff's going to happen this year, not just the beginning of stuff, but actually the culmination of many of these terms. It could be, we try to put blinders on. MSA does, momentum structural analysis. And we don't, I mentioned that I saw the front page of the journal today, but I don't try to pay attention to what other people think or what other factors might be in play here. There are major factors in play, big fundamentals in play. We all know that. Mm-hmm. In our last weekend report, we had a Fed funds rate chart going back like 30 years. I mean, you just look at the silly thing and you say, no wonder the stock market's gone vertical for a dozen years. I mean, the Fed funds rate's like at the bottom of the page and it's not even hiccuping. It's at zero. And we hiccuped a little bit and back to zero. And for 10, 12 years, no wonder the stock market was inflated. We've had inflation for many years. Mm-hmm. It just didn't go into commodities until beginning October or so of last year, when asset managers again did what? Change their preferences from stocks to undervalued commodities that have less risk, probably more reward. And sure enough, that's what's happening. Mm-hmm. So now we have what the public and the Fed call inflation. In fact, we've had it all along. It's just been expressed elsewhere in a vertical stock market. So I think that bubble's going to burst. Not that the flow of money from the Fed or the ECB or the BOJ is going to stop or taper. It's just going to go elsewhere. Mm-hmm. Because people aren't going to put it where the Fed would like them to put it. And there's some other vulnerable areas out there that you've got to watch as well. You don't just look out your window, your windshield. Look out your left and right mirror. I'd look at high yield corporate debt, such ETFs as HYG, JNK, junk, and also look at muni bonds. Those are two asset categories that aren't behaving like T-bonds. Whereas over the last couple of months, while the stock market's gone up, and they generally have moved with the stock market up, the Fed bought them, in fact, last year. Bought those two asset categories outright. They've gone down for the last few months. Well, the S&P's continued up, so they've divorced from the S&P. Now, who's right? Is the weakening muni bond market and the high yield corporate debt market, and they're just above levels that we think if they break them, they're headed down. They haven't broken the levels yet. We're very number specific in our reports. We've got numbers just below the feet of these markets. But if you break those two markets, we suspect the S&P is going with them. Now, what's the central bank going to do when the debt markets they must defend are breaking down? Are they going to taper? They're going to raise rates? Yeah, I think not. And I think gold knows this. Basically, the central banks of the West are caught in a historical dilemma of their own creation. And they're going down the swirly along with their policies. And I think they're going down the swirly this year.
So it's interesting that you brought the Fed funds rate chart up, and that was actually where I wanted to go. Like, what do you think the possibility of the Fed actually raising rates is? Will they be forced into trying to raise rates for optics maybe, and be forced to back off after that?
Well, again, who's going to be head of the Fed? We're going to know probably in the next week or two, because I suspect it may not be Powell. Though really, I don't think it matters, frankly. Whether he stays or Lael Brainerd takes over, although we know she'll be more accommodative. Biden doesn't need a weak stock market. He's had too many things go against him. He needs the Fed to defend that category, okay? And I'm sure she will. Just like Lagarde in Europe at the ECB, she's not flinching, okay? But I think that they will continue their policy. Because if these other asset categories, again, we're looking at our side mirror, muni bonds, junk corporate debt, high yield corporate debt, if those start to fracture, and if the S&P even wobbles 5% off its high, and the sense of doubt rises among the public and asset managers as well, then the central bank has no choice. They can either implode those structures by raising rates, or they can come to their defense. They have no other alternatives. And I suspect their answer will come to their defense. And then, of course, what do you have? You have monetary excess beyond anything you've ever imagined. And ultimately, that won't last either. Why? Because it's not feasible. You end up with a swirling.